In 2008, the global economy collapsed. It felt like the world's financial system had a heart attack. Stock markets plummeted, iconic banks failed, millions of people lost their homes, and the world plunged into the worst financial crisis since the Great Depression. This was the Great Recession. But how did it all happen? How did a problem in the American housing market bring the entire world to its knees? The story begins not with a bang, but with a bubble. In the early 2000s, following the dot-com bust and 9/11, the U.S. Federal Reserve lowered interest rates to historic lows, making money cheap to borrow. This cheap money needed to find an investment, and housing seemed like the safest bet. Banks began handing out home loans to almost anyone, even people with poor credit and no proof of income. These risky loans were called subprime mortgages, often featuring low teaser rates that would balloon into unaffordable payments years later. As more and more people borrowed, the demand for houses skyrocketed, and so did their prices. A frenzy took hold. Everyone, from first-time buyers to speculative investors, thought the value of homes would rise forever. It seemed like a foolproof way to build wealth. But the banks didn't stop there. They didn't want to hold on to these risky loans themselves. So Wall Street's financial engineers came up with a clever and ultimately catastrophic idea. They bundled thousands of these mortgages, the good, the bad, and the terrible, into complex investments called mortgage-backed securities, or MBS. They then sliced and diced these packages and sold them to investors around the world, from pension funds in Norway to banks in Germany. To make them seem safe, credit rating agencies stamped these toxic bundles with AAA ratings, the highest possible grade of security. Wall Street was essentially selling a fruit salad made with rotten fruit and telling everyone it was perfectly fresh. For a while, the gamble paid off, but by 2007, the bubble began to burst. The teaser rates on the subprime mortgages expired, and homeowners' monthly payments shot up. Unable to pay, millions began to default. As foreclosures surged, the housing market was flooded with unsold homes, and prices crashed. Suddenly, those safe mortgage-backed securities were revealed to be worthless. The investments that propped up the world's biggest financial institutions were built on a foundation of sand. Panic spread. Banks stopped trusting each other, and lending ground to a halt. In September 2008, the unthinkable happened. Lehman Brothers, a 158-year-old financial giant, declared bankruptcy, sending a tidal wave of fear across the globe. The collapse was swift and brutal. Trillions of dollars in wealth vanished overnight. Millions lost their jobs, their savings, and their homes. To prevent a complete meltdown of the global economy, governments were forced to step in with massive bailouts, using taxpayer money to save the very banks that had caused the crisis. The decision sparked outrage and protests like Occupy Wall Street, reshaping politics and leaving deep scars of inequality and distrust that still affect us today. The 2008 financial crisis wasn't just about money. It was a catastrophic failure of regulation, ethics, and most importantly, trust. When banks gamble recklessly, it's everyone else who pays the price. The question is, have we truly learned our lesson?